Hi, good morning, everybody. I am Jacob Mathew. I run an investment bank based out of Bangalore called MAPE Advisory Group. I have pleasure to introduce Natarajan, Natarajan, a close friend of almost 20 years, fondly called Nats. He has been an investor in some of the large successes which you see around things like Make My Trip, ID Foods. Nats will talk about various other things he has been involved. He is currently supporting over 18 companies, six funds. Before this, he was one of the founding partners of Helion Ventures. He was also the chief person for University of California Ratan Tata Fund, which has had about 400 million US dollars, which invested in 16 odd companies. He was at that time also managing Mr. Tata's private investments, around 100 plus, all early stage investments. And at Helion, he was there for 10 years, managing about 3 funds totaling $600 million, invested over 75 companies. He's currently on the board of Navi Technologies, founded by Sachin Bansal of Flipkart. Also on the board of Virtusa Consulting, a 500 million US dollar IT company. Nats is also very active in the social space. I personally know him as the financial brain for one of the well-regarded school in Bangalore, Bethany High School. He is also on the board audit committee of Public Health Foundation of India. He is also a board member of Christ University Board of Studies. Also a trustee at Youth for Seva, Udayam Learning Foundation. Over to you, Nats.
Thank you, Jacob. So most importantly, I think Jacob is a very long-time dear friend. So it is not an unknown charter member coming and then moderating my session. So I think I am a lot more ease. And I must also confess, guys, that this is the first time I am doing an online coaching because while I have always been speaking in the sessions, and all the speaking sessions, I never used to make any PPTs. I am an extempore guy. But I think just to attract attention of all the people, and that too because it is online, I just try to put some slides together. What I think I will do is I will share my screen and then we'll start talking about it for the next probably 45 minutes. But I think more importantly, I would like to answer a lot more questions because I believe that it is a great opportunity for the participants to ask any questions. So I always tell in my live sessions that please ask any questions. Don't think that whether this question is relevant, not relevant, etc. Because no question is a stupid question. Only answers can be stupid, and unfortunately, I am in that end. So I think please feel free to ask as many questions as you can, and I will start the session now. Is my screen visible?
Just 1 minute, Nats. I think Akhil will stream that.
Akhil is putting up the screen? No, I think I'll put up a screen. I can share.
Okay, no problem.
One second. Wait 1 second. I think there is a challenge. saying screen sharing has failed.
So I can put it live for you.
Okay, please.
Akhil, if you can put it, please.
Yeah. Akhil, how many participants are there now?
So we have 100 plus people online. You can go ahead.
Okay, fine. Guys, I think the topic is do's and don'ts while approaching the investor, right? What I think, go to the next slide. Yeah. So how I would like to start the session is basically what is the time to reach out to the investor, right? So when you guys, hello, yeah.
So just give me.
Nats,
please continue while Akhil loads it.
Yeah. Okay, fine. So when you actually the time, so some people, some founders want to reach out to the investors at the seed stage. Okay, somebody that is at idea stage where you don't have any product market fit, you only have some idea. So we call it as a seed stage investing, right? And typically we say that at that stage there are three types of people who will invest, we call it as a FFF, three Fs, right? Friends, family, and fools, right? So we say that at that point of time, if somebody is trusting you, that itself is a. Akhil, are you putting the screen? Hello, Akhil.
He must be just doing it, sir.
Oh, okay, I'll continue. Okay, fine. So we call it as a three Fs: friends, family, and fools. So typically those people come, and those investors, we call them as angels, right? Because angel is someone who is coming to our life and then trying to light up us, right? And then we call them as angels in the stories, and then they are the real angels who are putting the hard-earned money in the business at a seed stage. So what they do is that they are basically trusting us. They are basically trusting the entrepreneur. Okay, the product market fit is not there. There is an idea, and they think that the idea will work. They have tremendous confidence on the entrepreneur, and hence they think that I think we should invest, and then the entrepreneur needs some money, and then they put the money, and then that investment is called a seed stage investment. Okay. Second stage people go is basically a pre-revenue stage. So what I basically call it as as uh, as a, as an investment where basically the the product is identified, right? But I think there is no revenue, right? There is no revenue. Product is identified. Uh, People also, the entrepreneurs think that there is a market. Okay, product is there. The market, they think there is a market. There is no revenue. So that stage is called a pre-revenue stage, right? The Even in this, the investor has to trust the entrepreneur and his gut about the market, right? So, so here also it is equal to a seed stage, but the only difference is from the idea there is a product, right? There it is basically one step on the top of it, right? And so this stage is also called an angel stage, okay, or a pre-revenue stage, okay. Now what is also happening is in addition to the angels, some early stage VC funds also come in this stage at a pre-revenue stage. And the third one is basically new investment for the new product development, right? So what happens here is there is some base product, right? And what they do is that there is some base product, but they need to expand the product, so they need the investment. There is some market, and they think that the market can be expanded, and I think, but they need to expand the product to go to a larger market, right? So that is where I think this new investment for the new product development is required. And then here again, either a institutional investor come in this stage, right? We are calling them as a venture capitalist, right? So there are a lot of people who will invest either a sub $1 million or $1 to $3 million. So this in this bracket, typically the investment will be lot restricted, mainly to for the new product development and also expand the marketability of the product, right? And the next stage is basically there is already a product market fit happened, right? Now in the previous stage, product market fit has happened. Now I think they need to start building a customers, and then they need to expand. Right now, this stage is called where the profitability is low or there is no profitability. Right, I think you need to get the customers. You need to convince them to buy the product. You are only trying to solve the problems of the customers. Okay, that is a stage, right? So we call them as series B or series B plus kind of a stuff, right? And then the next last stage is basically ramping up the business. So what is ramping up the business is basically a series C kind of a stage where I think at the time I think you go to the next set of investors. So till the profitability is low, you will typically go to a venture capital guys, right? After that, we call them as a private equity investors. Okay, so that is also called a growth capital, right? Again, next slide. Next slide, please. Okay, so what are the various sectors typically people focus, right? People typically focus on a product, right? So you know that there are a lot of this thing called there's a technology investing. This technology investing evolved in India since 2007. Now it's almost 13 years, and 2006 we started a venture capital company called Helion Ventures. And at the time, this is so funny, right? I think Jacob will remember that on those days it was a lot more services business, right? In the services business, what typically happens is I have not even put this as a sector because now nobody is investing in a services business, right? So services business typically what happens is that initially you need some money. After that, the money will come from the business, right? If you take a software services business, right? I worked in a US-based company called Avant Technologies, and there initially there were few investors who used to put some money, but very quickly we moved in 2 years. We moved to a $20 million revenue, right? And we were some 25% profitable, right? So what happens is that 20 million, 25% profitable, $5 million get accreted every year, right? So there is no need for any money beyond that, right? I'm just saying that that money itself will be used to expand further geographies, expand further new product, services, customers, etc. Right? But now the downside of services business is those companies will get valued only based on a profitability, right? So beyond a stage, what happens is that the company scales up, the company throws up cash, and there is a profit, and then that profit get a multiple, and that becomes a valuation, right? Now the situation has changed after 2007 2008. I think there is a concept called a product business system. Okay, if you take a fresh desk for example, okay, fresh desk started, and then so I'm just trying to give you as many examples as you guys can relate to, right? So if you take, then the product business came up. So what is product business? People develop a product, okay? So a lot more investment will go inside that company to develop a product, okay? Then the revenue model will be scaling up the product. For example, there will be a product, and on the top of it, there will be a platform, we call it, right? And people will come and sit on the platform and use the product to get their revenues, right? So what happens is that you develop a product. That product can be used by many customers, right? So what you will do, you will sell this product either as a license or as a SaaS, right? We call it a software as service, right? So what happens is that it is like buying a building and buying a house and renting a house, right? So in buying a house, what happens? You buy the product. So what they typically the product company do, they will license the product, right? But from the company perspective, that will not be a very profitable one to them, right? For example, they can license the product to some customers, and they will charge some $200,000, $300,000, $500,000 kind of a stuff. But that will be an one-time license fee, right? But what is more profitable to them is they will say that the product is owned by us. We will keep giving upgrades, right? You come in the platform and you use it, okay? And you can pay me as you use. Okay. Now, from the customer perspective, it is a very good one because they don't have to invest in a product of $200,000 or $500,000 and buy a product. Okay. And then who will upgrade it? Okay. Who will maintain it? And then they don't know whether this is going to help them to scale the company. Right. Today they think, right. And just saying tomorrow, I think they don't know whether that this particular product will be useful to them. So then the SaaS model got evolved. Okay. Earlier, people used to sell the licenses. So if you know SAP and Microsoft and all that, earlier they used to sell the licenses. Now what happens is that they are now starting like a SaaS model. So they say that you can pay per use. So what happens that Microsoft starting earlier, long ago, Microsoft used to give an enterprise license, right? So they will give an enterprise license to a company, and then as many people in the company can use. Now that is all gone. Now it is all pay per use. So what happens today? If you have 50 employees in your company, you buy 50 licenses, right? And tomorrow your company is expanded to 100 employees, you buy 100 licenses. Okay. Tomorrow your company become 3,000 employees, you buy 3,000 licenses. So what happens to the product company? So the product company, that is, for example, you as an entrepreneur, you are running a product company, your revenue expand in proportion to the customer revenue, right? Look at the beauty of the model, right? Your product is helping the customer scale up, okay, and you are getting a revenue by virtue of the customer's revenue. So basically, you are also running on the fortune of the customer. So this is a beautiful model because from the customer perspective, he is paying as he earns, right? So that is the model which has evolved like a SaaS model. Okay. And the second business which is now very interesting is basically EdTech. Right now you have been seeing that there are two darlings in the current scenario now. One is a EdTech, okay, and the second is a FinTech, right, and the third is a health tech. Okay, I'll little bit touch upon that. EdTech is basically now in the pandemic. I think everybody work on EdTech now, right? Everybody who is on EdTech can expand. How they can expand? Earlier, the children used to go to the school. They used to learn in the school. They'll have an ability to get to a technology support either in the school or outside the school at their home. Now there is no school, right? Now I think everything is online. Now what happens that anybody who has a EdTech business, they are now thinking of how can they expand the business to teach the children from the school. Now that is the new norm now, right? Whether you take a topper where Helion invested, whether you take some of these EdTech companies like a Byju's, like An Academy, like Vedantu. I'm just saying that there are so many EdTech companies which is now coming up now. The latest one in the block is White Hat Junior, and where the children are even taught to code at the age of 8, at the age of 10. So I think then you have a great math, you have a hey math. So the children are being taught on the math, the children are being taught on science, the children are being taught on XYZ. So I think all these are combined together under EdTech, right? Then there is a high tech. This is amazing. High tech is I am just telling you that I am part of the investment committee of two other companies, two other investors, and the kind of proposals now we are getting is on the high tech. So what is high tech? So there are 2-3 inside this, right? One is called space tech. So what they do is that there are many companies now. Earlier, I think space itself, I think, was considered as a big one. Even when you talk about a space, that is a big talking point. We don't know what is going to happen there, right? Now there are companies who are going to be launching rockets, right? I can tell you 3, 4, 5 companies at least I come across. And long back, about 4 years ago, there was a company called Team Indus in Bangalore, and Rahul was a founder, and Mr. Tata invested in the company, and he was wanting to launch a rocket, right? And we opened our mouth in a big way to see that, oh man, how is it because we were all thinking that only ISRO can launch a rocket. Right? And now I think all the small companies are now, because now ISRO is now decentralizing. Obviously they will validate, they will only give approvals, etc. But now they are saying that you don't have to come to us for launching a rocket, you can launch a rocket, right? So now at least I can think of 4, 5 companies. There is one Pixel, there is one Agnicool, and I can give you 2, 3 more names. So what these people are doing is that that's a space tech. What they do is that they raise money. Okay, at what stage they raise money? They raise money at an early stage. This is like a product stage, okay, which I told you. Yeah, it is all pre-revenue company, right? So what they do is either they raise it at a Series A or at best a Series A plus. So people put money in that company, and once they are proved, and once one rocket is launched, okay, so to launch a rocket, they need about a $1 million. Okay, now that is what the number going on. Okay, and once they launch a rocket, okay, their revenue will be $20 million per rocket. So they can launch, if they launch, for example, 20 rockets, okay, and 10-20 million dollar. So what happens? It's already 200 to 500 million dollar kind of a number. Okay, and some companies can launch after a successful launch. They can launch about 10 rockets in a year. Imagine that, and the profitability will be at least 40% EBITDA. Okay, so that is on a space tech. Second is insure tech. So what do insure tech companies do? Okay, this is a lot more in global. So some of these companies, when I told you about the product company or a tech company, a tech is a lot more domestic because the consumption is a lot more in India. But whether you take a SaaS model, whether you take a space tech, all these are global companies. So what it means is that company can be here, but the consumption can be across India. So your revenue generation will be outside India and in addition to India, right? So what happens is in a insure tech. So they basically help the companies to. There is one company which in one of our where I am in the IC, we are evaluating. The company has already tied up with us with a Star Insurance as a anchor client. Okay, now we can take this company outside India, right? So we are that is basically I will cover in the next what kind of investor you should look at. So it is very important that space tech is coming, insure tech is coming. Recently, today morning I met somebody who is doing basically a real estate technology company. Okay, the kind of stuff they are going to this thing already. Brigade has launched a accelerator program called Brigade REAP. Okay, now I think somebody else is going to do globally there are only 6-7 real estate tech company, prop tech company. They call it as so. So there is a space tech, there is a insure tech, then there's a prop tech. Okay, so like that, I think these high tech companies are doing very innovatively, right? And the last one is a manufacturing. Manufacturing is like a very steady state companies, basically, where you will be lot focused on manufacturing, revenue, profit, kind of a traditional companies. Okay, and there are still investors who want to come these kind of a manufacturing steady state companies, right? Whether it is a pharmaceutical, I'm sure that Jacob will remember some of his investment in pharmaceutical companies where there is a very clear investment, there is a capex, then there is a working capital, there is a good amount of revenue and very predictable revenue, predictable profit. Okay, now I think we can think of scaling. Once you have that, then I think you need a minimum support from the investor because you yourself have money. Okay, again, next slide. Next slide.
Akhil,
Okay, equity or debt. So that is the next slide. So basically, I think what people should consider is typically I understand that many of the entrepreneurs and many of you in this room would always think of equity. Okay, always think of equity. Okay, just remember that equity is most expensive mode of financing. Okay, most expensive. So when I was working with Wipro, Mr. Premji always will say that you have to consider a 28% as a cost of equity. So he has got some calculations on those days about 15 years ago. So as to why 28%. Okay, but what I am trying to tell, even now I think that as a Bible. So I consider 28% as a cost of equity and debt cost of debt, and then I try to compare. Right. So I think my submission to you people is I think when you are looking at a financing for your business, you should think that the equity is not the only option, debt is also an option. Okay, so you need to have some equity. You can't take everything debt because first one, I think you will not get the debt. Okay, second, I think all these debt guys ask for collateral, collateral, and all that stuff. But I think more importantly, now there are a lot of working capital financing coming up based on the cash flows of the company. So I sit in the board of a company where I think we get it's a company called Life Cell Diagnostic Business. It is where we get in a biobanking, we get over close to 200 crore. We get operating cash flows coming in the company. So what happens that against the cash flow, you will be able to get a debt. So you don't have to go to the equity route, right? So what I was trying to tell you is there are three considerations you need to think. One, urgency of the requirement. Any fundraise, guys, will take 6 months minimum. Okay, don't think that somebody will come to the some investor will get excited and he will write a check tomorrow. It will take minimum 6 months. If you are able to raise money from an investor before 6 months of the start of the discussion, then you are so much blessed by the God. I can tell you that. Second is what is the quantum of the fund you require. I think it is very important to know that what is the money you require, and you need to typically raise between 18 to 24 months ka money. Okay, between equity and debt, because if you think that you will raise in 1 year, as I mentioned to you, fundraise is a 6 month cycle. So if you raise the money for 1 year, immediately you have to go for a fundraise, right? You will be doing only fundraise. You will not progress on the company, and nobody will invest money with you because they will think that you are not growing the company. Okay, so I think that is another thing. Third very important thing is think big. Think big. Okay, I think that is a lesser problem with most of the entrepreneurs, but bigger problem is basically on how do you think big. Okay, how much you can grow. And I think it is very important that you need to take a right amount of money at your right time. That is very important. Okay, that is also the reason that you need to decide that how much you want to raise money. Like I mentioned to you, you should not raise for 1 year, but you should not raise for 5 years. If you raise for 1 year, you will be constantly doing fundraise and nobody will invest. If you raise for 5 years, you will end up doing a diluting lot more in the initial stage. Okay, but at the same time, don't be too skeptical in sharing ownership. Okay, if your company is at idea stage, if you get a $3 million valuation, I think gladly take it. If you get a $5 million valuation, and if you are raising a $2 million, it is a 40% dilution. Doesn't matter, take it. $2 million will last you for 2 years, and with that next round, instead of against 5 million, you should think of going to a 20 million, 25 million, 50 million. Okay, rather than you are now you instead of now what you are thinking that, oh, at 2 million, how can I dilute a 40%? I will dilute only 20%. Now, in that conversation, 6 months go away. So you need to have a balance between the time to raise money and the dilution, and also the time money is required in the system. More important, very, very important, and I am sure that Jacob will stand upside down on this. Okay, please look for support beyond money. Okay, don't look at, yes, Jacob.
Yeah, looking for support is good. I have a question from one of the participants. I don't know who, but I got it on the chat.
Yeah.
The question is, I'm just reading it out. For a product company in seed stage and ready for market penetration, what stage will be ideal to approach investors?
Okay, so I think you should approach when you think the product is reasonably ready. When you think the product is reasonably ready and you think that there is a market for this product, I think you should approach the investor. And before approaching the investor, my suggestion is please validate the product and please validate the market. Because never think that it is such a confidential you cannot share with, discuss with few friends, few well-wishers, etc. At this stage, I just want to give you an example. There is one company where I think it was a company. I don't want to tell the name because I think all the people are around. So it was a company where I think where we were evaluating in Helion, and I think we were going to invest. And the founder said that X% should be on the board from Helion side. But this X% was already in a large public company, and they also had some line of business. Okay, but this founder was very skeptical. He said that no, I think my company is a very confidential company. I don't want the detail to be shared, and I think this person should not be sitting in that company board because they are doing a small work, etc., etc. So we were all thinking that, oh, how do we this thing? And then we reached out to that founder of a large company, and then said that, boss, please understand, please excuse us. I think he may have to withdraw from the board of this company to join that company. So that, look at the maturity of that person. Okay, and he said, please resign. Please take out all the material from here and share it with your new company. No problem. Okay, look at the confidence. He said, ultimately, it is all execution. So don't too much worry about if I share this idea, that guy will take this idea and then go and then raise some money and all. Nothing will happen. Okay, be confident on yourself. Okay, one is a product. Guys, biggest thing is execution. Biggest thing is execution. Okay, so I think first you have to socialize the idea of the product and of the market with few people. And once you validate the idea, you can go to reach out to the investor. Okay, did I answer the question? Yeah, Jacob.
Idea, Nats, how do you validate the idea? We have this joke among the old world economy, entrepreneur coming to see us and saying that, look, Liril is the best, largest soap brand in the country. I have a new soap which is double the quality of Liril and costs only half the price. So the standard investor response is, so what? It's all about execution. The product per se doesn't make any sense.
Correct.
Everybody, all of us sitting at home and while sleeping have lots of ideas, but question is, are you able to run with the idea?
Yes. So that is where, Jacob, I think the validation comes. For example, if I as an entrepreneur have got some idea, I think I should go to some few well-wishers and who can really tell, who can really call spade a spade. There are lots of people who will say, oh, great idea, I think you should go. There will be few people who will question, like what you said rightly, saying that, so what? If Lux soap is costing, I don't know how much it costs, so 50 rupees, for example, and if you are bringing down the cost to say 25 rupees, okay, and is it going to be a great thing? Okay, now you can bring down the cost from 50 rupees to 25 rupees. Now the well-wisher will ask a question, guys, how do you reach the market? How do you reach the customer? Okay, you may have a problem, but how do you reach the customer? So I typically ask Jacob, three things I ask. One, what is the real problem you are trying to solve? Number two, how ready the customer is to pay for the problem he is getting solved. Number three, how quickly he will pay the money. Ask these three questions to yourself first and be very honest about it. You can cheat me, but you can't cheat yourself. So you ask this question saying that, number one, is there a problem? The biggest problem today, Jacob, is the technology guys. They get very high on the technology. They don't focus on the business problem. So from the investor perspective, we will get hype only on the business problem solution, because the guy is paying money for solving his problem. He is not worried about the technology, nor the investor is worried about the technology. Investor will always focus on whether you will be able to solve a business problem and you will be able to get a money for that. So first question is, can you solve what is the business problem you are solving? Second question is somebody willing to pay money for that? Third is, how quickly he will pay money for that? So I'll give an example. For example, so there is a problem. So now you are saying, so there is, I keep meeting a lot of entrepreneurs, and then I ask this standard question that who is your competition? Okay, many people say there is no competition. So I used to tell them that if there is no competition, then maybe there is no problem only, right? Because I think there is no problem only, man. I think you are Jabardasti trying to solve a problem, right? Which is not required to be solved, right? So when I talk, some entrepreneurs will think that I am very aggressive. But I always tell them, guys, if I don't tell you this feedback, okay, I think I am doing injustice to you, right? I am doing injustice to you, because I think you will go back with a great feeling that I think, yeah, I think everything is solved and I think I'll get, but I think you will get hammered by the investors. Just also remember that I think you should read the investor. Very important, you should read the investor. Okay, there are a lot of investors. I think all of us are, most of us are become very, very polished now to just politely look at this thing and we'll say that, yeah, we'll get back and all that. Most of the people don't even get back. Some people will get back and then say that my IC rejected. They will not even tell you the true reason. Only very, very few people will tell the true reason. Okay, so I think it is very important that you should read the investor. You should know that, that is why I'm saying fundamentally go back to these three. What problem I am solving? Is the customer ready to pay for the problem? How quickly he will pay for the problem? Can you go to the next slide? Yes. So this is a very important one, because I think you need to decide what type of investor you need to get. Okay. Where is your, before that you need to see, where is my market? Okay. Where is my customer? Where is my company? Is my company headquartered in India or outside India? Do I need a domestic investor? Do I need a global investor? Okay. Where is my customer? Is my customer Indian domestic customer or outside India customer? Accordingly, you need to decide which kind of investor you need. Suppose if you think that throughout the life of the company, you need only $5 million, then I think you can go to a typical $100 million, $200 million kind of a fund, where I think it is 5-10 million is okay. Okay, but if you think that you need a deep pocket investor, I think it is very important that you need to think 5 years from now where you will be. Okay, there was a joke I kept reading saying that imagine if you had asked somebody in 2015 where you will be 5 years from now. We were all in COVID, nobody can, everybody would be wrong, right? So it is not like that. I think you need to see that where my company will go, and then you need to factor 2 flat years. For the next 6 years, if you are making a plan, budget 2 flat years. Okay. Other thing I think you need to imagine is, I always do one thing, very, very simple. Okay. Whatever is the money that somebody is asking, the entrepreneur is asking. If entrepreneur is saying that I need $10 million, I will multiply by 2. Okay. And if he say that I will reach $20 million revenue, I will divide by 2. So whatever the entrepreneur say, he will do only 50%. And whatever money requirement he is saying, we need to double. Okay, think that perspective. And 95% of the time I am right in my 15 years of investing. Okay, 95. And I remember that publicly I can tell you, when Amazon was started, I think, I don't want to tell the name of the person, but I think somebody went to Jeff Bezos and then he said that I need $50 million for India market. And Jeff said that please add 2 zeros to this. Imagine. Okay, that is the, and then that is nowhere now. That also we know. Okay, and at that time, this is in 2015. No, sorry, not 2005. Okay, 15 years ago. Okay, imagine. So that is the vision of the entrepreneur should have. Entrepreneur should think that what type of investor he should choose. There is no point in choosing an investor just because he wants to invest, and just because he is giving some money, and just because he is giving a high valuation. Don't go to that. You should, like the investor is doing a due diligence on the company, you should also do a due diligence on the investor. Next slide. So like I mentioned, I think don't go only based on the valuation. Look at the value add the investor can give to you. Look at the credential of the investor. Look at the geography where the investor is based, so that he will give you connects to the customer connects he will give you. I remember that there was one investor, how quote unquote he screwed the founder. Okay, in the documents there will be a line called, at all points of time investor shall own 20% of the company. Right? That is basically in that round. Okay. Okay. So the investor took that literally and then forced the founder that I think I will not dilute in the next round. Founder was shocked, and ultimately he had to dilute to raise the next round of money. So you need to be very, very careful about the credential of the investor. Okay, you need to see that what is the value add he will give, whether he will help you. Okay, so I think please do not go only by the valuation. That is very, very important. Yeah, next. Okay, like I mentioned earlier, I think you have to decide the quantum of money. Okay, you should not be too much paranoid about the dilution or valuation. Okay, and the next important one, this is very standard one, right? I think while we all should be very confident, okay, but I think the confidence should not turn to arrogance, right? I think unfortunately it is only a thin line between self-confidence and overconfidence, right? I think I can do it is self-confidence. I can only do it as arrogance, right? It's only one word, right? So the entrepreneur, my submission to the entrepreneurs is, don't think too ahead of yourself. I think be humble. Okay, check with the independent advisors. Like I mentioned earlier, I think you need to speak to some good advisors. Okay, so Jacob is one of it. Okay, so we can Jacob, you are on mute. You are saying something.
There is a question from the audience from one Sunil Gupta.
Yeah.
What do you advise startups after seed stage and angel round for raising funds? To appoint investment banking advisor or to approach the funds directly? The question is from Sunil Gupta.
Yeah. So that is a very good question. So there is always a dilemma between whether we should go with the investment banker or we should you should go directly. So my submission is, I think that all depends upon the quantum of money you want to raise. Number one. Number two, the type of investor you are looking at. Okay, and these two are very important one. And number three is basically your own ability to interact with the investor. There are a lot of entrepreneurs I have seen who cannot manage the investors. Okay, who cannot manage. Suppose if you have to raise a $10 million or a $20 million round, and then this will come from 2-3 investors. Okay, then probably I think it is best to go through an investment bank. Because I think you may have to interact with, if you have to get a 2-3 investor, then you have to go to a 10-15 investors, right? You have to make a proper IM, investment memorandum, and then you have to interact with the investors and all that. then in that case, I think best to go through an investment banker, because they will also supplement your bandwidth and then manage the whole show. But if you are going to raise after series pre-series A, if you are going to raise $2-3 million or maybe up to $5 million, then probably I think investment banker is not required. You can just reach out to investors directly. But in any case, I think you may require some kind of an advisor who will help you to reach and then what to talk, what not to talk with the investor, etc. Some of it we'll cover now, and so that would be my suggestion.
That's another related question from one Akash Kumar. Question is, what percentage equity can be let go for investments till the company is profitable? And if it's a very good idea, what is the proportion of investment amount to equity that can be taken at different stages? I mean, the question is, do I dilute highly early on so that, when the company is profitable, I may be left with only a small stake, or should I keep everything close to my chest? I don't know. I have some views, but let me first hear your views.
Okay, so I think I want to take your views also. So why don't you start with your views?
Akash, the answer is very specific to a situation, depending on how much money you need. A typical entrepreneur normally is a bit reluctant to dilute, wants to dilute 5%, 10%, but please understand, 100% of zero is still zero. So, having 100% of the company that is not going anywhere doesn't not going to help. There are investors, entrepreneurs who actually grew quite big, but at the end of the day only had 10% or 15%, but 15% of $20 billion is a large, huge amount of money. So all depends on what the idea is, how much this thing is. My simple liner would be, don't be too greedy. The investor is there to make money. Don't be jealous of the investor making money. He has taken a risk and made the money. And that's your view?
Yeah, so absolutely. I think you are bang on right. I think there is no right answer, Akash. I think there is no one answer and there is no right answer, and nobody can give you a right answer. I can tell you that. Okay, and if somebody say that it is not a science. Okay, it is an art. It depends on, number one, how much money you need throughout the life of the company. That is very important. Number two, I think at what stage you are raising money. That is a second important thing. And a third is basically, I think you can also consider, beyond a point, you can consider linking the return to the investor based on the progress of the company, or linking the valuation, what we call it as a ratchet valuation. For example, depending upon the performance of the company, you can say that I think you can negotiate with the investor that I will dilute less, or I'll get a more stocks back if I perform this. I think some of these, I think the investor will be very open to that. Okay, but my submission again, as Jacob rightly said, don't be greedy. Okay, just remember that investor is here to make money for his money. Remember that. And the important thing, think that it is not his money. He's a money manager, guys. Remember that. Okay, if I am running a fund, I am collating money from various people, and then I am managing the money. So I have to give a right investment return to these investors. Okay, don't try to be greedy. So investor is as interested in your success as you are. Okay, it is very important. But having said that, there is no point in throwing the value. There is no point in agreeing to everything, whatever investors say. There is no need. You have to be very balanced. Okay, it is very important. As Jacob rightly said, I think there is no point of owning 100% of a zero value company. It is zero only. At the same time, no point in adding a 0% of 100% 100 value. That is also zero. Right? So it is very important to have a right kind of, that is where I think the right investor, right advisor is very crucial to many of the startups. Right advisor is very crucial. The advisor will tell that what you can dilute, what you cannot dilute, how much you can dilute. He will put a lot of practical things in your head. He will advise you. Next slide. Next slide. So I would like to keep this in three buckets. One is identifying the investor, approaching for the investment, working with the investor. And in each of these buckets, I will little bit talk about what we should do, what we should not do. Next slide. So in the identifying the investor bucket, one, I would like to say that you have to identify the investor of your niche. It is very important. You should not, if you are a technology company, don't go for an investor who has a consumer background. Okay? Because I think it is very important that you get a right insight of the technology and vice versa. Second is very important, you should build the relationship with the investor. Okay, just remember that I am sure that Jacob is smiling, and I think that I know that how much relationship he has built and then how much time he has invested in that relationship. So I used to tell that I think you should have breakfast, lunch and dinner with the people. That is a relationship you are building. And it is not that it will come tomorrow. It will come over a period of time. You will not believe that I met somebody 1.5 years ago, and then today, last week he called me and said that can we meet today? And then today morning I met him at 9:30 in Starbucks, and then I got a deal clinched. Right? So while I met him 1.5 years ago, I kept in touch with him. Right? Then when there was a right opportunity, he reached out. So it's very important that you build a right relationships. Third is seek advice. Don't seek money. Most of the entrepreneurs I see here is seeking money. The first meeting is asking, I want to raise 3 million, what valuation you give? Don't do that. The right investor will not like it and he will go away. I am telling you from my 15-year experience, we just don't like that. Last is make a warm lead. Okay, how the warm lead will come, it is because of the relationships you build. For example, when you reach out to Jacob, the first call, you cannot just call Jacob and say that, sir, I have this, can I do this? He will not appreciate it. I'm just putting words in his mouth. I don't think anybody will appreciate. But how can you do? You have to develop a relationship. Now that you have participated in this call, now you start building a relationship with us. Build a relationship. Develop a relationship. Bounce your ideas, bounce your thoughts. What do you think you can have? What do you think? If we are interested, we will come back to you. If we are not interested, reach out to somebody else. Somebody will come back to you. Once they come back, immediately don't say that I want 3 million. Can you raise tomorrow? I think you should seek advice. You should not seek money. When you seek advice, they will find 5 people who will give you the money. That's what typically investment bankers do. But I think more than investment bankers, even the advisors, what they do, they are not only advising the entrepreneurs, they are also advising investors. For example, like I told you, I am helping about 18 companies. I am also helping 6 funds. I am in the IC of 2 other funds, 2 other investors. I help a $2 billion billionaire in helping investing. So when I find that there is a right investment, I will reach out to my funds. I will reach out to my investment committees. I will say that I think this company is a good company. I think you should. But if you reach out to me saying that can you help raising money, I will not do. I will first drop the case. Because I am not an investment banker. I am an independent corporate advisory firm. So that is how I think you have to build a relationship. Go to the next slide. In approaching for investment, first you have to be very thorough with the business plan. Very important, you have to be thorough with the business plan. Okay. If I ask some question, yesterday I was in a board meeting of a company, and then I asked, what is the burn for next year? The guy did not know. So imagine, you are a bloody founder, you should know that what is your burn. Okay, so you have to read the plan before you reach out to an investor. Have command on your numbers. You should know the basic number. You don't have to know what is the money spent on printing and stationery, but you should know what is the money you are spending on marketing. You should know what is your employee cost. Some key numbers you should have command. Make proper research. It is very important. If the investor is talking to you about a related company in your space, you should not be blank. I have found that lot of people are blank on that because you are not doing a proper research. Last, very important is stay confident. You have to give a big picture to the investor. You have to talk inspiringly. Very important that you have to see why. When I was small, no, I will not forget this, right? And when I first joined as a management trainee, it was when Rajiv Gandhi was a prime minister at the time. And Rajiv Gandhi was running, we were just watching a TV, and Rajiv Gandhi was running to the stage. Okay, and I was asking my boss, okay, in a guest house, I was asking my boss, sir, why is he running? Okay, I will not forget this. He told that he is not running because the stage will go somewhere. He is running to exhibit his energy. Have you noticed this? Many politicians you would have seen, even now Sonia Gandhi will run to the stage, or you can take Akhilesh Yadav, or you can take Modi. People will walk towards the stage with a lot more energy. Why? People want to exhibit that energy because the energy will translate as energy. So when you stay confident, when you are inspiring the investor. When you are talking, you are giving a big picture to the investor. Next. What you should do when we are working with the investor, first you should share the bad news with the investor. Very important. Okay. Mr. Premji always tells me, first tell me the bad news. Because good news, a lot of people will tell. Second is, you have to be very realistic with your projection. Don't over commit and underachieve. Nobody likes it. Very important, be transparent with the data and info. Don't read in between lines. Okay, don't play cheap tricks. Nobody likes it. Because once you lost the confidence of the investor, he will not work with you. And anything happening, good or bad, keep the investor informed. Seek inputs from and guidance, but decide yourself. Very important. One of the company where we have invested, and the company failed, and the entrepreneur came to me and said that no, we were exactly doing what the Helion board member was telling. So I said, that is a problem. Why did you do? You should listen, but you have to decide. Now it is very easy to blame the investor, but from the investor perspective, remember one thing. Okay, we have so many companies. If one company failed, it is one of the company failed. But for you, the only company failed. That is the difference between investor and the entrepreneur. Before every meeting, please do your homework. Very important. Okay, without homework, don't go to the meeting. Yes, next slide. I'll wrap up in 5 minutes and then look for questions. Yeah. Don'ts. In identifying investor, very important. Don't be in urgency. Don't be in a hurry. I have seen one, the entrepreneur has got one term sheet. Fadaksa, he wanted to close. Why? What is the hurry? What is the tearing hurry to close? Be cool. And don't have a random approach. It is like we call it as a spray and pray. Okay, just reach out to 15 investors, send the deck, and then whoever come, let us see. Never do that. Never do a random approach. And just don't do a cold call. I told you earlier, nobody likes cold call. Next. While approaching for the investment, don't hang up on valuation alone. I think I told this earlier also. I think these initial valuations don't matter. First, you have to build a company. So initially, it doesn't matter. You take some money at some valuation. I'm not saying give up the entire value, but you have to leave some value to the investor also. But build in that money and then reach to the next level. That is very important rather than hanging up on this and then losing time. Very important, don't be underprepared or unprepared on the company. That is very, very important. Mess on the business plan. I have seen many entrepreneurs not doing homework, come and then when we are reviewing the business model, then only they realize that this business plan, oh, this is wrong. That means they have not done a homework, right? Next very important one, be rigid and closed for the feedback. You should always seek feedback. Okay, there are many people who don't want to give feedback because they think that you will get offended. But very few people give feedback. Please take the feedback. Have maturity to take the feedback. It is only for your benefit. It is not to show his arrogance. It is for your benefit. So please take the feedback in a very, very positive way. Okay, don't be skeptical. So I have seen a lot of entrepreneurs saying, oh, this person will not do. Oh, this person has this thing. Oh, I have heard this lady is bad. Why are you worried? You are not going to marry that lady, right? You are taking an investment. I think don't be skeptical, be open, okay, and over negotiate. I have seen a lot of people negotiating. So then the investor will get a feeling that I think, yeah, this guy is chindi guy. He say काम मत करना. I think let us get out. So I think be very, very gentle in talking. Don't negotiate too much. Next slide. Very important, overcommit, under-deliver. Never do that. There are a lot of people who overcommit and they don't deliver. Information hidden. Don't hide anything. Be transparent. Tell the truth. If you tell the truth, you don't have to remember what you told last time. Right? Very, very, I will never forget this in my life. If you tell the truth, you don't have to remember. You are very cool, very peaceful. You don't have to remember what you tell last time because you are telling the truth. Right? Play with investors. If you have multiple investors, don't try to play one against other. Very, very important. Remember that investor community is a very small community. We meet very frequently. We share lot of things. Okay. And if you don't know something, just say I don't know. There is nothing wrong. Nobody need to know everything. You should say, sir, I don't know. Please tell how I can do. And don't build the company for investors. You are building the company for yourself. Investor is a shareholder in the company, but you are the owner of the company. So build the company for yourself. Don't build for investors. Next slide. Okay, great. So I will stop here. I can give several examples, but I want to take questions. And if you still have time, maybe I think I can talk some examples. Jacob, are you there?
Yeah, sir, I have some questions
Yes.
which has come here. 1 minute,
Yes.
I'm just.
Yes. Jacob, you may like to turn on your video.
Oh, sorry. One question is from Sunil Gupta again. What are the typical valuation multiples for software product companies as opposed to software services companies? Difficult one, but we have a joke that the valuation multiples are normally the same for products and services companies. For product companies, you get a multiple of revenue. For services companies, you get the same multiple of profits. But
Yeah. Just to add to what Jacob was saying, I would say that there is no right answer. Okay. So Sunil, I think while this is a master class, this is not a speaking engagement, but I would tell you that there is no right answer. I think it depends upon the company. Okay. So even within the product companies, the multiple will not be similar to an insure tech company. Between a health tech company and a edtech company, the multiples are different. Between a fintech company and insure tech company, multiples are different. Even within fintech company, their multiples are different for a different fintech models. So I think there is no right answer. Okay, that would be my answer to this.
The next question is, do you have any other suggestions rather than blue chip companies for making investments? I'm not too sure what the questionnaire meant, but I guess people like Nats and me sort of make investments in non-blue chip companies or startup companies for a living.
And we want to make you as a blue chip company. So after our investment, yeah. So I think let him clarify. Please clarify this question more.
Okay, I don't know. It has come in the chat.
Yeah.
The next question is, during valuation discussion, what are the points that founders should consider in defending or asking for a specific valuation?
Yeah.
The question, my sort of this thing is, lots of people start the discussion saying that, look, I'm looking for $5 million for a 10% stake.
Yeah. Yeah.
Stop at I am looking for
Yes.
$5 million. Don't say
Exactly,
whether it is 10
exactly.
or 5 or 20.
Exactly. So I just want to give you an example here. There was one company, again, I don't want to name the company, it is now sold. So in that company, so I always tell the entrepreneurs, okay, don't tell the valuation. Investor will keep asking, what is your valuation expectation? You should just say, keep quiet. Okay, you should not say keep quiet. You should keep quiet. Okay, you should just say pagle aap. Okay, first you. You should say that, sir, you are investing. Please tell your number. You are not expected. You as an entrepreneur should be in a listening mode. Don't ask for a valuation number. The investor should tell a valuation number. You should not tell. As Jacob rightly said, you say, I am looking at raising $5 million. No need to tell what dilution you will give, because there is two danger, guys. Okay, one, if you put a high valuation number, the investor will run away. Okay, because he will think that the expectation will not match. Now, if you put a very low valuation number, then also investor will run away because you don't have a right thinking. So what is the thinking? You have to just keep quiet. Now, I will give an example. There was one company where an investor was supposed to come. So fortunately, this company, the founder was talking to me long back, about 10 years ago. He asked me, well, the investor is coming, what should I tell? I said, don't tell about valuation. Okay. So two founders were sitting and the investor was sitting there. And one of the large investor, okay, one of these Tiger, SoftBank, some of these families, okay, one of the fellow was sitting. And then, so the investor asked promptly to the entrepreneur, saying that, what is your valuation expectation? So my friend actually pinched my other co-founder, saying that don't tell. Okay. So he said that, sir, I think you should tell. Okay. So that guy was telling, saying that, oh, we cannot give you valuation beyond 60 million, because beyond that, I think it will be very difficult for us to push in the investment committee. These two guys were thinking the valuation at 20 million. Imagine. Okay, so they couldn't control their excitement, but somewhere they controlled and then they kept quiet, and then the deal got done. And what I am trying to tell, look at this. Suppose if these guys have said 20 million, I'm 100% sure that investor would have gone away, thinking that these guys don't have a big vision. So my learning from that instance is never tell, because if you tell too big, there's a problem. If you tell too small, there's a problem. So don't tell. You are not the person to tell. The investor has to tell. Yes, Jagat.
This is a question from Anand Sitaraman. For a startup at very early stage, should the valuation be based on revenue or should it be based on idea? Does idea or execution be evaluated?
So if you yourself are saying that it is an early stage, so I presume that you don't have revenue. So it will be based on the idea. If you have a revenue, also it will not be based on the revenue, because it is only a start stage, right? I think if you are getting $100,000 as a revenue, I don't think that anybody will value the company based on that, because I think they will think about your idea and the potential to earn the revenue. Jacob, you want to add anything?
Yes, one of the things I think Nats was talking earlier is about making an impact on the investor. Yes, idea is obviously relevant, quite important, but more important is you as an entrepreneur. First, the investor has to feel confidence in you, confident that you will make a business out of it. There is a joke that as an investor, I am okay with funding a group of guys with a bad idea, group of good guys with a bad idea, but I am not quite okay with funding a group of bad guys or
Great idea.
non-performing guys with a good idea. The idea, whatever idea that makes sense today
Yeah.
may not be relevant 6 months or 12 months down the line. So
Yeah.
investors take the view that, look, these guys are smart. Look, even if it doesn't work,
Yes.
they will pivot around, turn around, do something else.
Yes.
Um,
Yes, 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 absolutely. I think what we call also an extension of what Jacob was saying in the investment world, we call it as a first who, then what, right? I think we want to see that whether these guys are reliable, and I think whether these guys have a right thinking, whether they are cohesive. That is very important. I think so. In Helion again, I think yeah, 4 people came. Okay, and then they set up a meeting, and then me and Ashish were on the room, and one of the question Ashish asked this guy, saying that, so what about your team? So one fellow answered, team, I am the only guy, all these guys are working for me. So we just closed the book. Okay, so what I am trying to tell, imagine this kind of a company, where can we invest? So I'm just saying, very important, as Jacob rightly said, I think we need to have a right team who will be able to pivot an idea. Today's idea may not be relevant tomorrow. For example, if everything closes tomorrow, if it is a bunch of good guys, they will be able to invent a new thing, right? And that is what the investor wants, right? Yes, next.
no other question so far, but while we wait for other questions, Nats, maybe you can.
Some examples. So I'll give an example. I'll give a very, very good example of a company called Azure Power, and which is today listed in Nasdaq. Okay, and I'll tell you how this company was pivoted, and most of you will be very happy to listen to this. So this entrepreneur came to India.
Nats, can you speak closer to the mic?
Yeah. So this entrepreneur, Inderpreet Wadhwa, he came to India from US. Okay, he wanted to start a solar power company. Okay, and in US he reached out to a firm called Foundation Capital, and there was a partner called Ashmeet Sidana. Ashmeet told him, saying that you are doing in India, you go to India, you find a India investment firm, and then we will co-invest. So he came to India, and Ashmeet introduced him to Kaval, and then Kaval referred him to Sanjeev, because this company was based in Delhi, and Sanjeev promptly declined the deal, saying that no, I think solar power, too much financial engineering, who will do this, etc., etc. So, but in our partnership, I told Sanjeev, saying that no, I think we should invest, because I think the downside is a lot lower than the upside, so I think we should consider investing. So Sanjeev said that the important thing in this company is the ability to raise a debt. How do we validate it? Okay. So we said that we will, so I told Sanjeev that I will take lead in this. Okay. So we told this guy, this Inderpreet, saying that we will give $100,000 to you. Okay. So we will give $100,000 to you. And he has got one megawatt order from Amritsar, Punjab government. Okay, and on those days that was costing 17 crore. Okay, so we said 1 megawatt. Okay, and we said that we will put okay, obviously we need to do a debt, so we said that you have to get and at the time the exchange was some 45 rupees or something. Okay, so we said that we will put $2 million, 1 million each, that will be 9 crore, and I think you have to get a 10 crore loan. Okay, and then if you can manage that, so we will not put $2 million now, because we don't know whether you will be able to get you will have an ability to raise a loan. So we will put $100,000. Okay, so we put $100,000. I put $100,000. Ashmeet put $100,000. $200,000, which at that point of time was 90 lakh. We kept it in a bank. Okay, and then we allowed him. And those days, I think you can allot shares for up to 6 months. Jacob, I think you will remember this, right? So we said that we will give you $100,000. Okay, and then by 45 lakh we gave him the money. Balance 45 lakh we put it as a fixed deposit. Okay, and we said that we will wait for 3 months. Within 3 months, you have to raise a loan. If you are able to raise a loan for 10 crore, then I think we'll release our one. We release the 100,000. Balance we'll release 1 million each. Okay, and then you are good to go. But if you are not able to raise, I will write off this 45 lakh. I will close the fixed deposit. Both of us will take $50,000. We'll write off $50,000 each. You understand the math? This guy was amazing. Okay, he raised a loan of 10 crore in Oriental Bank of Commerce on those days. This was 2008. I'm telling you. Okay, and I must tell you, in the next 7-8 years, he raised $200 million. Okay, the who's who of the investors came in the cap table. Okay, we had IFC, we had OPIC, we had CDPQ, we had many investors. We raised over $200 million, and finally this came as this was listed. This was listed in the stock exchange in Nasdaq. We flipped the company. Okay, and I remember that I got him a chartered accountant, and I got him a lawyer who charged 50,000 rupees a month in 2008, and his billing was 6 crore. Okay, when he went to Nasdaq public. Okay, imagine how everybody else grew, and then how the company scaled. Okay, so what I am trying to tell, look at the vision of the entrepreneur. Okay, the entrepreneur was very clear. He was not bothered about, oh, this guy is giving for 45 lakh rupees. He is putting lot of conditions. He was very focused on his vision. He was very positive that he will execute it. He was very positive that he will build a $1 billion company. So that would be my suggestion to the entrepreneurs is, I think when you are looking at an investor, look at like this. Look at having a good partner with us, and we are still holding shares in the Nasdaq listed company. Okay, so that is how I think we help build a great companies. Any questions?
Yeah, one interesting question, politically sensitive question. Would you prefer a young entrepreneur or a not so young entrepreneur to fund? This is a
So
politically
that's
sensitive
a very
question.
great question, and I think I must congratulate the guy who has asked this question. So I think it is not a question of young or old. Okay, let me just tell you that. I think I always tell this saying that age is only a number. Okay, so it doesn't matter. Okay, I think what is your thinking level? Okay, I can tell you 100 people who are very quote unquote old and who have no right thinking, and I can also tell you 100 plus of young people who have a very good thinking at the age of 20s, 21s. Okay, there is one company, I will name the company here, a company called Pixel. Okay, which is Inventors funded company, and the entrepreneur is 21-year-old or 22-year-old, amazingly thinking. There is another company called Euler Motor, which is again Inventors and Bloom invested. Now ADV is coming, and amazingly, my sub 25-year-old, amazingly great thinking guys. Okay, so there are lots of people, young people who has. So I think we don't decide based on young or old. I think we decide based on the quality of the entrepreneur. So we meet the entrepreneur, we meet a couple of times, then we frame opinions, right? And that is how I think we do it. Jacob, you want to add more?
Yes, but other things being equal, all of us would prefer to back a youthful entrepreneur. Politically, not the correct statement, but one of the things least talked about in India is, over the last 5-7 years, there is a huge premium on youth. I mean, if you are 50 plus, like me or Nat says, it's generally very difficult even to find a job. Jokes apart, I have classmates who have had whatever. Everybody wants 45 minus, not 45 plus. The rationale being that you have much more energy. And I will talk about a friend of mine. You probably know him, Nats. This is Alluri, who was used to run Morgan Stanley's private equity investment in India. He personally has become a high angel investor. He has about 15 odd companies. He was telling me that, look, you know, the so-called old guys who have done well in corporate jobs, many a times have a fixed, ossified way of thinking.
Yes.
And, you know, in his review calls, he says the older guys tend to have a lot of excuses about why this has not happened, why that has not happened. He says the youth, the young guys, somehow sort of jugaad karkar, you know, somewhere
Yes, they will get it done.
manage to find a way out rather than, you know, blame others or blame the environment.
Yes. So one of my friend used to say that we hire for experience and we suffer from that. So, so I think long and short, I think obviously, I think youngsters have not. So you don't have to get disillusioned because you are a youngster and you may not get investment. You will get tons of investment.
In general, you know, while most investors won't say that openly because of it being politically not the correct statement, there is a premium on youth.
Yes, yes, yes.
And if you look around, many of the startups have been done, most of the larger startups have been done by youthful entrepreneurs rather than seasoned entrepreneurs.
Absolutely. Absolutely.
Any
other questions?
We have just 5 minutes left. Anybody has any question? One last question I have is, if you have raised money on some hypothesis and with some planned areas of deployment of funds, but then the founder changes his minds and wants to deploy in different areas to which the investor is not agreeable, how to solve such a dilemma?
So I think you have to convince the investor, right? And if you are not able to convince the investor, he will walk out, because ultimately, see, there are two things, right? One is he is putting his money. He is putting money for a certain idea which he thinks that you are going to do. Now, if you are changing that, there is no problem. But at least you should be able to convince him that that is the idea for which will give a much better return, and then within the investment thesis of the investor, etc. Otherwise, I think it will be, and if you are not able to convince, then I think it is only a persuasion and a conviction. That is what I would say. Jacob, you want to add anything?
Yes, respect capital. You know, no point in saying he is a fool, he cannot understand. He is, as Nat said, otherwise, he is managing somebody else's money, a third party money. He has a fiduciary obligation to people who has given him capital. So, you know.
Hello, Jacob? Hello?
So I'm guessing his video got froze.
Yeah, I think Jacob's video is paused. Okay, so Akhil, is there any other question? Because I think we have only another 4.
No, sir. Yeah, that was the last question, sir.
Okay.
We'll probably wait for a second for Jacob sir to come back, or
yeah, and we can do a closing comment.
Yes.
And Akhil, probably you can share my mail ID with people, and if anybody has any question, they can just write to.
Sure.
I think Jacob lost connection.
I think he'll join back.
Probably. He'll join back.
So I'm guessing he was not able to.
Yeah.
So probably we'll conclude the session. Thank you.
Okay. Thank you very much, and thanks for Tai to organize this session, and thank you so much for inviting me.
Thank you very much, sir. It was a very insightful. If you can just wait for a second, Jacob is just rejoin.
Yeah. Hello, Jacob. I think he's connecting.
Sorry, I got thrown out. I just joined back. I think we have anyway running.
Yeah, I think we have to close the call. Yeah.
Thanks a ton, Nats, your years of experience in investing, whatever, maybe you should, last 2 minutes, you should talk about the multiples of money you have made. I know I am personally aware. I don't know. Make My Trip, you guys made what, 20 times
No,
your
I
money?
think, yeah. I think ID Fresh was a good example. I think that I know that how we have helped him go to the next level, and then how great attitude he was having. And Easy Tap is one. Now actually one of our investment, PubMatic, is listed in Nasdaq now. PubMatic last week it got listed. So I think we have made a lot of good investments. We have invested in Big Basket. We have invested in Live Space. And in UCRNT, we invested in Ola Cabs. We invested in M-Swipe Technologies. So I think Nestaway we invested. So I think, and we do, if I say that all my investments have done great, I think I must be lying. There are also some investments which will not work out. And that is a game of investing, right? I think some will work out and some will not. And the successful investor have to make the ratio of successful investments more than the failure investments. And ultimately, I think both investor and entrepreneur are working together for the success of the company. So we are all, both me and Jacob will be very glad to take any question. We have requested Kochi to Thai Kerala to share our mail IDs, and if you want anything, please reach out, and we will be very glad to help any one of you to the next level. Thank you.